Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month lead and tin.
LME 3-month lead. The last of the big main drivers from last year, seen since late spring and throughout the summer as well as going into autumn and now winter, had been the construction of the June to date double bottom pattern. It is a lopsided double bottom, but it's nevertheless still there. The market had most recently in December last year been scaling upwards on the second part of this double bottom. Indeed, prices looked like they managed to trigger it in early December, but in the end there was only a single close back then over the key level, and the market bottled it. As I said 10 weeks ago in trying to justify such a pattern, and I quote, "You'd need at the very least prices to exceed and properly exceed the 50% Fibonacci line of the June to October 2018 move at 22.21. End of quote. In late December, the market tried again and did make multiple patterns higher, multiple attempts higher, with good closes, but the daily patterns were, well, very bitty, running into a fourth countering level and peaking with a shooting star pattern, type 1 bearish, 3 weeks ago, before collapsing back into a combination of supports that I will shortly detail. This now brings me to the recent pattern that had been dominating the action since late September. It is the late September to late October last year bullish shift pitchfork, highlighted in purple on my daily chart. This bullish shift pitchfork has been pretty good, bar a couple of minor breaches, and it is at this point that I introduce the supports that have been very effectual in holding the recent decline. First off, take a look at the lower time, currently at 20.91. Though this was breached, it had only the one close below and has seemingly repaired itself early last week. Next we have two moving averages, the slowly declining long moving average currently at 20.76 and the rising medium moving average also currently at 20.76, but not a golden cross or a dead cross. Finally, we had the January 2020 high at 20.39 that was approached but not tested. The market reverted higher last week through the 50% Fibonacci of the March 20 to March 22 move at 21.35 and made a big move up to the combination now of the middle time, currently at 22.51, and the 50% Fibonacci line of the previously mentioned June to October 2018 move at 22.25, and now the 50% Fibonacci line of the whole of the 2022 move at 22.25, where prices stalled and then dropped back down to that 50% Fibonacci line at 21.35. The market is seemingly now caught between two forces, centered either on the two 50% Fibonacci lines at 21.34 and 20.25, or the 50% Fibonacci line below at 21.35, and the pair overhead at 22.21 and 22.25. I'm not sure which will overcome the other, but I know that such a situation cannot last, so personally I look to the tines of the bullish shift pitchfork for what may act as support and what may get broken. Just be aware of false breaks, multiple false breaks in either direction. There's one thing that might help in this matter, and that is something that was set up by last week's move lower. We are set up today for a possible monthly key reversal here, so that if we close tonight either over 22.92 or under 21.79, then we'd be on. Anything in between those numbers and we would have a lesser outside month. Right now we're looking at a monthly key reversal down, but only just. LME 3-month tin. The move up from the turn of October into November last year rose into a series of stratified resistance levels that slowed but did not halt the market's rise. The major ones were, and still are, at the following levels: between 23,000 and 24,155, at 21,360, and between 20,435 and 20,510. Since Christmas, the market has broken higher through the 2013 high at 25,250, the 2012 high at 25,875, the lesser Fibonacci line at 27,330, the July 2011 high at 29,010, the lesser Fibonacci line at 30,205, and finally the interesting 50% Fibonacci line of the March 2020 to March 2022 move at 31,845. I said last week that any move up to this level, this 50% Fibonacci level, will be the real test of any rally. And so it proved to be, as prices did not break up over the 50% Fibonacci line, but they just breached it with one single close over it late last week, before we have seen prices head lower, gapping lower indeed, over this past weekend. Last week I drew a November 2022 to date uptrend, which is currently at 27,575, which I've highlighted in dark blue on my daily chart. It would not surprise me to see prices dip down to this uptrend, to at the very least to gather some ammunition for any potential move upwards. In the meantime, whilst we're waiting to see if this does or doesn't happen, I would like to leave you with what I call my big thought part of my commentary from last week that I think is still relevant and is valid whether we drop down to the lows of October last year or we bounce up off the uptrend. So, part is from last week and part of it's from a time before, even that. And I quote, "Then there is a big thought I'd like to ponder again, if you will, and an even bigger thought I'd like to share. 9 weeks ago, well, this is now obviously 10 weeks ago, 9 weeks ago I said, and I quote, the action since late August has caused me to think that perhaps the action is a possible descending scallop pattern. I'd like to see more on this to be sure, but right now it looks like a lot like that to me. I'm minded therefore to give just a provisional idea on the upside for such a pattern, assuming of course it does not peak and revert back down, which would also be in line with this pattern. But for a continued move higher, you would have to look primarily in the 25,035 area, and possibly later on should it continue up to the 27,475 area. I'm not ready as yet to start naming targets for this pattern, but it is worthwhile being prepared, just in case, as I can easily discard these if they prove unsuitable." And that was the end of the original quote. This was, and I'm still quoting from last week, this was the big thought indicated back then, and I am pleased to say that we have seen the market reach all the relevant targets for what I am renaming the small descending scallop pattern. Now comes a new bit. What if, and this is a big if, what if the action since March last year is part of a really big descending scallop pattern? In this pattern we have seen the move lower, and we are now on the upslope of the ski slope, or inverted J pattern, as it's sometimes called. Thus, if the rise does halt, and it may not be that soon, then perhaps, just perhaps, we can start measuring for a further big move lower or higher. And that's the end of that quote and the end of this part of the commentary.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.